Now we have 15 minutes for questions and answers. I'm sure we may have a lot of questions about the market direction. Looking at these slides, yeah, we have some opportunity for making some money. So just raise your hand. My colleagues will, after my instruction, he or she will give you the wireless mic for you to raise your question. Yeah. Casey, yes.
Thank you, Professor Breeden, for this very stimulating presentation. Just look at this slide. I think you are right in the sense that if you compare current market pricing versus long historic probabilities, there may be a discrepancy. But then in reality, in the market, people don't look at 50-year time frames. I buy something today, I want to know what the prices would be, not only the next day, but probably the next minute. It goes back to this idea of how funds are flowing and momentum trading and all that. And for traders, they think a lot more about what prices are going to be. So they feel the mass psychology, and if everybody is risk aversive, I better be risk aversive before that. So have you ever tried to integrate this kind of dynamics into your analysis? And
I haven't really. It'd be the honest answer on that. I have not, but I would say that some of my teachers, when I was in MIT, I was very fortunate that I had Myron Scholes to teach me and Bob Merton, and then I worked with Bill Sharp at Stanford, and a bunch of great faculty members. And of course, Scholes and Merton were involved with long-term capital, which did great and made a lot of money until it didn't in 1998 and got hammered. And then that happened to a lot of people, including myself in 08 and 09. And as I reflected on all this, to me, I thought, these are good people. Now, they're smart people, super smart people. So how did such bad things happen to such good people, including me? That kind of leads me into this dark realm of behavioral finance and behavioral decision making, where I basically started talking to my deputy dean, who was John Payne, who's a superstar in behavioral decision making. And he says, you're all humans. And there are some mistakes in decision making that all humans make. And maybe even some mistakes that smart people make even more than people who are not quite so smart, like overconfidence and things like that. Jamie Dimon referred to that when JP Morgan lost a bunch of money in London, as he said, I think we became complacent and overconfident. So anyway, one of the things that, as I studied the long-term capital story, that I found is that it looked like they were using a short time period because volatility had come way down recently, and the longer time period would have, if they were protected for the long time period, they would have survived, whereas they were protecting for a short time period. There was also a study in the UK by the Turner Commission, I guess, Lord Turner, I think, that basically said that in the financial crisis of 08 and 09, it appeared that most people were using models that only went back like 7 years. Well, the previous 7 years to the financial crisis, were very steady years generally for the economy. It was the great moderation in the US, as I said. So anyway, people have gotten into a lot of trouble by using samples that are too short. And I think that's called memory bias. That was discovered by Kahneman and Tversky, and Daniel Kahneman won a Nobel Prize for that. So I think actually that's the danger. That's why I like to look at long samples rather than short samples.
Thank you. And here, this, the Jiwoo, yeah.
Thank you, Doc. I'm thinking as a policy tool, right? So the implied distribution, what additional information would this give to policymakers? To me, the distributions are really a reflection of the market responses to central bank policy actions and other major events. So if the implied distributions simply capture the responses by the market, much information that is new, that it's actually useful to the policymakers?
Well, that's a really good question, and there are a couple of answers I could give that I think are good ones for this, which is, I remember that I had a slide, and I've given this talk for like 3 years, so to put in new slides, I have to take out old ones. And one of the ones I took out was when Jean-Claude Trichet was head of the ECB, and Greece was starting to hit the fan as the accounting problems were exposed there and worries about Greece going down. And he said, no, we're continuing with rates up, or we're holding rates. They didn't drop rates. But the market dropped rates. The market pricing here went to lower rates. So the market clearly didn't believe Jean-Claude Trichet. And then I have another slide that shows that with Ben Bernanke, that when he was talking about it, maybe this was early in 2011, and he said, we're going to keep rates down, but he wasn't precise. And the markets did not move as he probably anticipated they did. And I think he indicated that later. And so the next time he spoke, he was much clearer about it, that we're going to stay low until the end of 2013 for 2.5 years, and then the markets moved. So I think that the policymakers can look and say, did the markets react the way I thought they would react? And if they didn't, then they might say, well, maybe we weren't clear, or maybe the markets don't think that what we're saying is going to make sense. Now, another illustration, I have not analyzed the Bank of Japan, but I remember when they went to negative interest rates, you know, they thought that the yen would go down, and instead the yen went up. You know, they would have found the same type of thing, that the markets didn't move the way they thought they'd move. And I think that that would cause you to kind of re-examine either your communication or, you know, does the market know something that we're not seeing?
So the communications office for central banks should pay particular attention to this.
I think that's true. And I suspect the head central banker, like Chair Yellen, I'm sure, looks at these. I know that the Fed and the Bank of England have this data. When I presented this to the Bank of England, I said, so I understand you use our model. And they said, oh, every day we have it cranked out. And so they're aware of taking the information out of option prices.
There's another question from Ellie. Yeah.
Wonderful presentation.
Thank you.
One thing that's striking about this picture is it seems to provide a good measure of risk aversion. Now, as economists, we don't like risk aversion to change. It's very hard to work with changing risk aversion in models. But here, if you do green minus light blue, or blue minus light blue, or blue minus light red, it seems to be a measure of risk aversion. Do you think, or have you tried it? Does this change very much? Because here, in one day, green and blue are so different already.
Excellent point. And thank you for those points. I think in the same way. Now, I have the tables that I've been looking at. I've been working with these since early this year, maybe last year. I started getting into this quite a bit. And the table I have actually calculates the value of the left tail and the right tail day by day. And I did not have the historical frequencies on it. I just had the price of the left tail and the price of the right tail. And I took the price of the left minus the price of the right, which is usually a positive number because of risk aversion. People are paying up for the left over the right. And I computed that time series. And then I looked at that and said, okay, so how did that behave in 08 and 09? This will be the subject of one of my next papers. I'll have this graph there. And of course, in 08 and 09, as we went into the deep recession, the pricing of the left tail went way up relative to the price of the right tail. So that spread went way up. And if I spread them versus the historic frequencies, you'd get some similar results. But yes, I like looking at that. Now, what Litzenberger is encouraging me to do, as he's just kind of sitting in the sidelines, Litzenberger became very wealthy working for Goldman Sachs and bought a county in Pennsylvania and has a beautiful home there. So he just gets to sit and tell me what he thinks I ought to consider doing, and then I do the work. But he said you ought to look at kind of these time series, and I should do more of what I've begun to do today. This is the first time I've put these slides up together of the stock market with the bond market. And he says you should integrate the two of those and see if there's a relationship between the moves in the stocks and the bonds. So I'm just beginning to do some of that. And I think that what you've described is exactly the way to look at this.
Yeah. Yeah, and other questions from.
And I have looked at some of that, and it does move in intuitive ways, in pretty sensible ways there. So,
In your presentation, you allude that monetary policy certainly is in a very interesting time. Actually, I would say in a very difficult time. So I'm wondering, instead of you lump all this data together, for example, from 1927 to now, to 2015, whether it would make sense, for example, to break that into a few periods. If you look at it from international monetary system perspective, after the gold standard, basically before the Bretton Woods system was established, in 1944, 1945. So I would think that from 27 to probably 1944, 45 was a period that's very interesting to look at. Mm-hmm. And then, of course, from 1920, basically 45, roughly to 71, 73, after of course, gold is depegged to the dollar. I think that's by itself is an interesting period. And you mentioned in your presentation that in the 70s, I saw that probably from 71 or 73 to 85, 87, depending on how you think about it, plus or call, that's another interesting period of time. And then basically 85, 87 to 207, 208. After 208, I would think that it's a totally different interesting period of time. So I think that if you look at it from such a perspective, I'm wondering, maybe that the distribution, everything would look probably by itself very interesting. I'm wondering whether you have some thought about that. That, to me, probably would give us a lot of insight about where monetary policy should be doing. I mean, including on communication.
well, those are excellent points too, and I take them all quite seriously. My problem would be just data limitations, in that to apply our Breeden-Litzenberger method, we need prices of options with a lot of different strike rates. And I remember Myron Scholes and Fisher Black did their first paper on pricing options. I think the empirical paper came out before the theoretical paper came out in 73, 72. But I don't think we have a lot of option prices for different strike rates going way back. They analyzed at-the-money options, I think, that they got from a kind of a over-the-counter broker. So that's going to be our problem with applying this. Now, we can certainly do the calculations on the historical frequencies of stock returns over pretty much any period, because we have that monthly and even daily data back to the 20s. So that we can do, this historical frequencies, and that's a good idea to do it over these different.
Can I have the last question?
Okay.
This gentleman first. Then the last two questions.
Last
yeah.
two. All right.
Yeah, last two. Yeah.
Thank you, Professor, for your great presentation. I have a question. So, for nearly a decade of low interest rate and quantitative easing, huge amount of liquidity floods into the bond market, especially the Treasuries, U.S. Treasuries. And now many people think that the U.S. Treasuries are overvalued. So what's your opinion about the price movement, given the fact that Fed is rising interest rates now? And what is your comment for asset allocation? Thank you.
Sure. Well, I would have to say, first of all, that's another excellent question, comment. I would agree that they probably are overpriced. And, as one nearing retirement, and I would like to allocate more of my portfolio to bonds, I wish the interest rates were higher. I mean, this is something, Bill Gross wrote a nice editorial for the Financial Times a few days ago, where he talked about the problems of low interest rates. There are big problems with low interest rates. They hurt retirees. They hurt investors like that. They hurt pensions and endowments who are trying to invest. They hurt insurance companies that are having to raise their prices because their returns are so low. So I certainly would like to see rates go higher. If that happens with these long duration bonds, I mean, at interest rates that are so low, the duration of a 30-year Treasury has gone from maybe 12 or 13 years to 15 or 16 years. And, it finally occurred to me that as the duration of a German Bund is like the duration of a zero coupon bond because it pays zero. And if it pays a negative rate, it's even longer than that. So if rates move by 1% up, you're going to get hurt badly because the durations on these bonds are very long. Now, that stimulated some other thoughts that I'd say, let me pass along just one of those. I know we're out of time, which is just that you know, it's different for the central bank to step in, as let's say Bernanke did in 08 and 09, and they provided even assistance to our banks and bought in, you know, they bought Freddie Mac and Fannie Mae, and they gave TARP money and things like that, and bought into Citigroup. They owned like 36% of Citi. They bought banks at low prices, and they made profits on that as the banks got healthy and actually made a profit. Right now, if central banks are out there like the ECB and buying bonds at negative interest rates, if they succeed, they're going to lose a lot of money on that portfolio. If they succeed in doing what they want to do, rates will go up and their portfolio will lose a lot of money. So that's a different circumstance from if Bernanke succeeded, they made money. I'm just not sure. Is the government ready for that? Or are the people ready for the government to lose a lot of money on these purchases? I hope they're analyzing that risk.
That lady, yes.
Thank you for the wonderful talk. Yeah, I believe the work has important policy implications. I'm just wondering whether, you know, what kind of implications for investors. Yeah, for example, we can look at this picture, right? Then the calculation on the implied wall or implied probability would tell me, okay, as an investor, the market's view, right? So we can see, okay, the market, the upside is selling cheap and the downside is selling expensive relative to historical data. And probably I also, as an investor, I disagree with the market. I also think upside has higher probability. So I can trade, right? But the problem is the market could take a very long time to converge or change, right? So how can I see the catalyst? I mean, yeah, we can do the calculation day by day to see the trend. But all the calculations are based on the realized data, right? Realized price, although the price is forward-looking. So I still cannot see, you know, how can I, you know, use the information as an investor. Yeah.
Well, I think that's totally fair in the following sense, in that I don't know where the market's going. I don't know where the stock market's going. I don't know where interest rates are going. I really am just trying to extract from the market prices, you know, whether the market appears to be really fearful or not, kind of the pricing through options. And usually the only relationship that I've seen that seems to be pretty reliable is that that lots of economists have found that when implied volatility is high and people are very fearful, risk is higher, and academics would even say if risk is higher, then returns can be higher too. So just when people are scared the most seems to be the time to generally make sure you're invested, probably. And at the same time, when people are really calm, and then it's probably a little more dangerous. But you know, I can't tell you where the markets are going to go. And the case for fixed income is that it's a hedge. That since we don't know where it's going, one reason to hold fixed income is if it goes the wrong direction in a way that I don't think is going to happen, but I've often been wrong, and if I'm wrong again, then the fixed income will pay off for you and will help diversify your portfolio. But I'm afraid I can't tell you where the markets are going.
Thank you for all the excellent questions and excellent answers.